James Sweeney with us from Credit Suisse, and my host this hour, Dominic Konstam of Deutsche Bank. What an absolutely remarkable time. James Sweeney, how do you define austerity in Europe?
Austerity is just fiscal cuts and rethinking how the political economy in Europe can work.
Let's gauge that. How did UK austerity, how much was there when you measure it to GDP? Was there 2% austerity, 5%?
Well, it was a combination of things. I mean, you did have significant budget cuts, but you also had quantitative easing on the other side. So in a way, in terms of net austerity, it was probably marginal because the central bank was doing a lot. What's happening now in the rest of Europe is that the fiscal authorities are being forced to really get in there and tighten, while the ECB monetary policy isn't really being as aggressive as they could be or as they were in the UK case.
Did you hear anything from Draghi that would suggest a different ECB that will move away from the German model?
Well, they cut rates, which is the start. So at least they're willing to do that. But I think it's still a wait and see. I mean, really the issue is what we call the sort of credit easing side of things, which is comes back to monetization rather than just playing around with interest rates.
Here's George Magnus. Earlier this morning on Bloomberg Surveillance, I spoke with Mr. Magnus of UBS, and I asked him if he's been surprised how much austerity has immediately affected the real economy.
It's not a new problem. I mean, it actually is following a script that you could have lifted out of the 1930s. Creditors and debtors really have different ways of thinking about the same problem. The problem in the Eurozone, obviously, is that there's just too much emphasis on debt or austerity and not enough on what the creditors can do to try to facilitate rebalancing, which is effectively what we want to try and see.
So there's a nice summary of the weekend and the speed of these changes within Europe. James Sweeney, what would you recommend the ECB do? Is it like a big TARP?
Well, I think that what's happened is that with $1.5 trillion of debt, Italy's bonds are really Europe's core safe asset, and the market over the past couple months has decided it's a risk asset. And when your safe asset becomes the risky asset, you're in trouble because you need to increase your savings rates and you need to really go into whatever safe assets are left. We've seen that in treasuries and bonds. I think that what Europe needs to do is it needs to do whatever it takes to make Italy a safe asset again, and inevitably that will involve some purchases by the ECB in addition to what they're already doing. But there's a trade-off there too, because the Italians have to show that they're willing to take the steps that will really politically allow the ECB to keep buying.
Dominic, ask a question here of James. Ask a question of James.
Well, I would sort of question, is it realistically to think that Italy can do the kind of austerity quickly enough to reassure markets? Because the political process, I think we've already gone too far down the road question for the process to really sort of gather any traction now. That's
true. A big problem is the political timeline being different from the market timeline, but I think that the ECB is in there buying, just about every day, and it does look like they are, holding back their purchases at times when they're getting bad signals from the Italians. So it could be that if we get some changes in the Italian government this week, we get some changes in terms of their plans in terms of austerity, that actually the ECB purchases step up straight away, and at the very least we won't see the kind of price action we're seeing today, which is very troubling.
And here's the price action. Let's bring up elegant chart here, and you can see here, folks, this is a remarkable chart. We've shown it before, the 2-year Italy and Germany, the two separate yields, not the spread. Those are the actual yields. I mean, Dominic, in your work, this is unprecedented to see this divergence, isn't it?
Well, I mean, in the EMU, it's unprecedented. I mean, obviously, we were used to all of that prior to the creation of the monetary union. So, in a sense, the market's just going back to...
The market is going back to pre-Europe.
Correct, yeah.
How can they push against the market vigilantes?
Well, I mean, I don't think they can, except the ECB can. The ECB is the only one who can do it, but they're not willing to do it. So that's where the choice, where the rubber hits the road.
Yeah, Willem Bouter talking $3 trillion. How much, both of you, how much would they have to put up?
The ECB?
Yeah.
Potentially unlimited. I mean, they'd end up a couple of trillion easily. I mean, they'd end up being willing to buy all of the debt.
Okay, so on a Wednesday, James, the ECB steps in against all of Bundesbank structure. They save the day. What happens the next day? Yields come in?
Well, I think you get a big rally in risk markets. You get something like the QE2 trade initially in the U.S., and you get concerns about inflation, and you get a weaker euro. But the reality is that that's very unlikely. We don't see that happening. We see potentially increased incremental purchases by Europe in response to austerity, but we don't see a big, sudden QE on that.
But go ahead.
I was going to say the problem is that what they've been doing, and there are a number of potentially good things, such as leveraging EFSF, trying to do the sort of super sieve, obviously having a bank recap plan and the PSI with Greece. All these are sort of small good things, but they sort of don't add up to sort of a solution. And there's probably too much focus on those things, and it's because of that focus that meanwhile in the background the damage continues to be done, which is a loss of confidence. So in the banking systems of these peripheral markets, and they're losing deposits as a result.
Maury Harris and Drew Mattis had a great note. We'll feature it later in the hour on just what it means for Americans. Does this really tie back into the U.S. banking system, this trauma in Europe?
If it's not resolved, I think it's potentially terrible. I mean, Europe itself is clearly going into recession, to my mind, and clearly will have potentially a very deep recession, much worse than the 2008 financial crisis.
Really? Do you agree with that? I mean, Neil Sauce is ambivalent, to say the least.
Well, I think that in a worst case scenario, a euro breakup type scenario, then yeah, you're talking those kind of risks. But some of the things that you had going into that crisis in 08 are not there now. You had, for instance, a big overhang in inventories. You had central banks which were a little clueless at first in terms of addressing interbank lending, getting LIBOR down. It took them a few months, and that's when the worst pain actually came out. So I think it's a little bit different, but I mean, if you're really talking about a breakup in euro, then yeah, that's going to travel. It's going to be a big, nasty global shock.
James Sweeney, thank you so much with Credit Suisse. We're going to